Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, the selection of a mutual fund scheme is something that people often debate about, people often seek advice about. And one of the questions that is asked by those that have a little experience is, should you opt for a mutual fund scheme in the equity space that is beating the market handsomely during a bull run, or should you opt for a fund that has relatively low volatility, that may not beat the benchmark or beat the market when things are good, but actually protects your money when things are not good? There are actually two measures that you can look at, and one is beta, the other is standard deviation. Beta actually tells you whether or not your fund is beating the market in the upturn, and standard deviation is a measure of volatility. These two metrics are what we're talking about today. Santosh Joseph, who is the founder of Germinate Investor Services, is joining me today. Santosh, thanks so much for taking the time. First question, beta, apart from it being a Greek symbol and a letter of the alphabet, what does it mean from the perspective of an investor?
Hi, Alex. Good afternoon. So I think you started with a great saying that beta is a Greek alphabet, and for many people it's still Greek. But I think for the viewers, we make it easy. That usually it's a risk measure that helps you understand how the fund performs in relation to the market. It's that simple. Now, for people who are using beta as a measure, they follow a thumb rule. That is, if the beta is equal to 1, which is the standard measure of beta, that means you will do as much as the market performs. Now, if the beta is less than 1, that means you will capture less than what the market captures. Now, remember, this capture or doing more or less than the market is connected to the market. So if your fund does as much as the market, then that will be the perfect beta of just 1. But if the fund captures less than the market, then you'll have less than 1, maybe 0.9, 0.85 or 0.95. But if the beta is 1.05 or 1.1, that means your fund will perform greater than what the market delivers, or maybe when in a downturn, fund will fall more. Now, generally, this is a great tool for investors to consider when they are putting their money in to align with their risk appetite they have. All of us are investing because we want to make money. Some of us are a little aggressive and therefore we want to make more money than just the benchmark market offers. And therefore, we use this tool to position our risk appetite while building a portfolio.
Interesting. So therefore, more than anything else, this is a measure of history, right? It's something that has occurred already. It doesn't necessarily tell you about what is to happen from this point on, but it's usually a measure of the tendency of a mutual fund scheme or the fund manager of the scheme. Now, you've very smartly and very adequately explained this, but I just have a question here, which is that if you have a down capture ratio and up capture ratio, which we've discussed on this program as well, which kind of tells you how a scheme is performing when the market goes up and when the market goes down. Is this different from that?
See, the beta is actually kind of indicative of even the up capture ratio, down capture ratio, and that's why you consider beta. I think you also very clearly pointed out that beta is a indicator. It doesn't predict the outcome. So now let's talk about the up capture and the down capture ratio. If your beta is more than 1, which means that when the markets or the index does well, your fund will outperform that index too. Now remember, if you feel that you take a fund which is going to be less volatile or risky, you go for a beta less than 1. You would have protected your down capture. But what will happen is when the markets are doing well, you will feel missing out for not capturing the upside. So you have to go with what you're believing for the fund to perform, because the same thing that prevents you from up capture will protect your down capture, and the thing that protects you from down capture will limit your upside. So you have to be a little cognizant that beta should be used the right way. It cannot predict, it gives you a sense.
You know, that's very interesting. We'll get to a few examples, Santosh, because we've often talked about standard deviation. I think this is also not necessarily a derivation, but it's kind of connected to this, right? Generally, one would assume that a scheme that has a high beta, which is it is falling more than the market, it is rising more than the market, it will likely have a higher volatility as well, a higher standard deviation as well. How would you explain standard deviation?
Okay, first I'll explain standard deviation. That is the measure of movement of the fund's performance and how it performs. Whereas beta is connected to the market, standard deviation is just the range at which the fund performs. More or less, it's the kind of bumpiness of the ride that you will experience. Now, usually when the beta is high and the fund is outperforming, it just tells you that the fund will slightly have a higher standard deviation than normal. It's because it is outperforming. There will be a little more fluctuation in the probability of the way returns are generated, both on the upside and the downside. Now, there is a good correlation between a high standard deviation and a high beta fund. It's because of the way the returns move. In a way, it's not a negative aspect. It just tells you that it's not a straight line. There is a probabilistic change in how returns are generated. And therefore, again, it's a good tool to tell you, do you want a bumpy ride? Do you want a smooth ride? In both, remember, do you want higher returns or do you want lesser return? The market is the end goal.
Okay, so just to put this in an example and to make it very, very simple, if my return of a scheme compounded over a period of 5 years has been 10%, and if the standard deviation of that scheme has been 15, then that means that at any given point of time for me as an investor, that scheme might have been giving me 25 plus or minus 5%. Is this correct?
Absolutely right. So what it tells you is it won't give a straight line 15% return. There will be a degree of variability. It measures how much that variability is. Let's use an even simpler example. You're riding your car, and if your average kilometer is 60, to arrive at average kilometer 60, there'll be times you'll go at 85, 90, there'll be times you'll go at 25, 30. But still the average is 60. Now, if I tell you the average is 40, then those degrees of variability changes. So most people think that low standard deviation is good to select the fund, without forgetting the point that even slightly higher standard deviation but a better outcome of performance is also important to the decision we make.
Let's take a look at this from the perspective of examples. And here, Santosh, let's look at the diversified funds, which is your multi-asset funds and your flexi-cap funds. Let's talk about schemes that have a relatively high standard deviation in beta and relatively low standard deviation in beta, and how they've performed over the last 3 years. How does that data look?
So when you look at the data, and we've just taken very simple data, easy for everyone to follow, the last 3 years calendar year returns, since we're in the early part of the year, and we look at the data, we've sorted it just by the way standard deviation drops down and beta drops down. It's interesting to note, and also maybe this is with the impact of how 2025 year has been a largely flattish year, in both flexi cap and the multi-cap category, choosing a fund with a moderately good standard deviation and beta, which is a beta of maybe below 1 and a standard deviation of between the 13 and the 14 range, has actually given you good outcome. A classic example of this has been maybe Parag Parikh fund. On the other hand, choosing a fund like, let's say a quant, which has got very high standard deviation and very high beta, is also giving you a very different outcome in the year like 2025. But just for the sake of representation of accumulating this data over a 3-year period, you would notice that if you're an investor, choosing a moderate amount of standard deviation with a beta closer to 1 actually helps you even overcome that variability of returns and gives you a smoother return.
There are exceptions to this though, because I'll talk about the scheme that you referred to, which is the Parag Parikh Flexi Cap Fund. And I mean, it is ultimately the exception to several rules, where you have a standard deviation of less than 10, you have a beta of 0.6, which means that it's only rising rising less than the market, it's falling less than the market, but its performance cumulatively over that 3-year period is 67%, which is just 3 percentage points shy of your best performing scheme in those that have relatively higher beta and standard deviation. How do you explain that, Santosh?
Well, that's the beauty of numbers. When you take a certain defined set of numbers, it throws up something that surprises most people, saying that how can a fund have a beta of less than 1 and have such low standard deviation, yet give you returns so close to the one that's taken the aggressive stance to make money work. It clearly tells you that this beta and standard deviation is not going to be indicative of performance or underperformance. It helps you realize that yes, you've taken a slightly lesser risk adjusted fund selection to go for you. In markets like this, where especially the last 15 to 18 months, where we made an all-time high and then we took really long time to come back to that, the tendency is to choose low standard deviation and low beta funds. The stance that you take, that is number one, will the markets be bullish and tearing away? Number two, within that frame, do you want to be in a fund that is going to be aggressive? So the net outcome is that in general selection for an investor and for the benefit of the viewers watching, there is no merit in being in an aggressive standard deviation or beta oriented fund just because you have an aggressive stance. Aggressive stance doesn't essentially mean that you're in the risky funds. Returns can also be generated in well-managed funds where the fund manager and the scheme is able to deliver an alpha even though the risk measures are contained.
Yeah, it's a very good point. And I think to a certain extent, which is why you need to consult with an advisor, because they'll be able to help you based on their judgment, what level the market is at and what the probability is of a broad-based rally. Because if there is a significant probability, Santosh, of a broad-based rally, then those schemes that have a slightly higher beta might actually be better off and might perform better. Thanks so much for taking the time and for speaking to us on NDTV Profit.